it when he makes time to come on the Big Joel call. So everyone, you're on the Big Joel community call Mondays, every other Monday, 2 p.m. Eastern, 11 a.m. Pacific, and all time zones in between. This is streaming live on Facebook, LinkedIn, and YouTube, and then we'll live on YouTube, Facebook, and LinkedIn as well. If there's things that you like and you want to go grab it again, or you want to share it with someone else. Those of you new to this call, we do use the chat. I usually don't actively use it when I'm talking. Clayton is very good at using the chat. If he is referring to a certain article, he will, there we go, right there. He will put it in the chat for you. Just remember, when this call's over, the chat is gone. So Clayton is the chairman, president, he'll probably correct me, of HousingWire, which I would say is the premier sort of place for mortgage, real estate, and anything having to do with those type of industries. I always love having Clayton on because he's got his finger on the pulse of what is going on both sides. As you all know, last week you had me ranting on and on about the market and the things you need to do to make sure you stay in this market and you don't get knocked out and you can survive through. We've been talking a lot about, obviously, a rising interest rate market. Clayton, one of the things we talked about last week, I'd love to just hear your opinion on this. I don't want to hijack, because I know you're always prepared, so I don't want to hijack you. But my opinion is to really get these adjustable rate products back in play, we actually need to see the 30-year fix go up a little bit, because the spread is not big enough. And the products, I mean, I'm sure people are working on them, but they're just not there yet. And I really think if the rates actually go up, nobody wins, please. If the 30-year fixed rates go up and we can get some aggressive 3, 5, 7, maybe even a 1-year arm that we can explain, Clayton, I've been telling my group to find a mentor. If you've never sold anything but a 30-year fix, to find a mentor so people can start teaching you how to sell the other products. I think it will really turbocharge the market because, we'll be able to qualify, 1.5% lower than where the rates are right now. I'm just curious in general. I don't ever need anyone to prognosticate on the rates, but what are you hearing about that in the market as far as product coming to market for these large non-bank lenders? Again, everyone, Clayton Collins, HousingWire. Clayton, thank you and welcome to the call.
Why, thank you, Joel. Yeah, ARMs are definitely a hot topic right now. Sorry, I got some late season allergies hitting me right now, so hopefully I can muscle through here. But I was at NBA Secondary in New York last week, and many conversations kept coming back to ARMs. There was a whole session on what was supposed to be non-QM and going into self-employed borrower scenarios. And I think adjustable rate mortgages kind of stole the show, and everybody talked about ARMs for 45 minutes. So yeah. And like the feedback from speaker like Shelly Griffin from Deep Haven talked about every conversation she has with loan officers. She gets asked about ARMs. They come up in every meeting. It's so relevant. That raises some. There was a panelist from Moody's on the panel, and she jumped into their confidence in the ARM products. I think when ARMs start popping, like the agencies can start to get a little bit nervous. But the quality of the ARMs that they're seeing come through Moody's so far, they've had nothing but confidence in, which is also a good sign. But that topic of higher rates being good for ARMs, but potentially good for the whole market is something that our lead analyst, Logan Bodashami, has talked about a lot in the last 6 months. And we tease him that he's been in team higher rates for about a year now, and that's a lonely team to be in. His rationale on higher rates isn't just to shift people from conventional to ARMs and make adjustable more attractive, but more so to put some pressure on this incredibly out of whack supply and demand dynamic, which just isn't being solved as we kind of come through the spring and look to home builders and existing inventory to solve that out of whack imbalance. Kind of continues forward, and a little lightening up in demand is probably the only thing that makes the market a little more healthy. And health in this context measured by home price appreciation that is not exceeding 15%, which the latest read in April was at 14.8. So we're still looking at this crazy home price appreciation market that's just getting tough for a lot of different reasons.
Yeah, it's again epic as far as inventory is concerned. We still have overwhelming demand, but we are seeing, Clayton, across the country. I think I operate in just about every state except for Wyoming. Whether I'm talking to agents or loan officers, we are starting to see a little air coming out of the balloon. There's not 10 offers, there's 4. People are slowly in smaller markets able to get FHA loans through. The very crafty, smart loan officers were getting the VA loans through, basically throwing the Patriot flag, meaning calling the seller and literally saying, "Wouldn't you rather, have a veteran have your home?" But the FHA loans, Clayton, one of the wildest things that's going on is obviously everyone's volume dropped immediately off the highs that were what I call refi bloated highs, right? So not only did volume drop for all the major players, but profitability came to a screeching halt as well, because if you were running at 40% govies, maybe you're running at 10 because no one could get those loans through. They're all conventionals. So even that profitability in the back of the house, which a lot of these loan officers honestly don't really care about. It's not as big of a deal for them. They just need good products to write loans. It is a big deal at the back of the house when they start looking at layoffs, because not only did the volume drop, their profitability dropped. A double whammy for these companies. I'm sure you're seeing that, right?
That was one of the big lessons from the Q1 earnings report. I think last week was kind of the end of the Q1 reporting period, and the two big themes that kept coming out were this massive pressure on margins and the lenders' kind of an initial reaction to margins out of whack is to look at headcount. And kind of to tie that back to the theme from MBA secondary, we kept hearing from loan originators that they're working harder than ever to originate and process and get loans through, compounded by the fact that a lot of the big lenders are reducing headcount and processing and underwriting and specific groups like condo and flood. So originators are carrying more of that work on their own, making the job harder, but all in an effort to combat some of this margin compression that's happening at top of house. The other big reaction to margin compression was looking for ways to gain market share and diversifying revenue streams, and that's the new product mention you just had, Joel. Seems to be the next reaction to, hey, how do we bring more revenue in? Product mix is one, and then like the longer term goal of making more money off of kind of like a book from a play from the real estate brokerage playbook of like the core services. What can we earn off title and insurance and other revenue lines that we can cross sell into the consumer, into the home buyer. But those themes were pretty consistent across every single 10Q that we saw in April.
And then, the other thing that's going on, Clayton, that's not as much talked about, everyone knows me, I'm a pretty forward guy, I really don't care, is that you have a whole battalion of loan officers that have never originated any kind of loan except for a 30-year fixed, have grown up with automated underwriting and online applications, don't even talk to the client, they just bounce them in there. And they've been supported, rightly so, by these big companies that have done a great job at capturing all that business by supporting it on the back. And what we're left with in this kind of market, Clayton, where we lay off a lot of those key bodies internally, is we're left with a lot of loan officers that actually they never learn their core business. Like, they can't do a pre-qual on a napkin with a pen and a calculator. They literally can't do it. And because they can't do it, they never hand in great loans because no one showed them, because they didn't need to learn. Now they're handing in a not so great loan, and the people in the middle are gone. They're laid off. So now that's going right to the back of the house and imploding. So from a market share perspective, these big dog LOs are taking market share, but some of these companies are having a lot of internal issues because their good LOs are waiting in line behind loan officers that they're not bad loan officers, just no one ever taught them what to do. They're handing in files that need a lot of work, and there's no one to work on them. So there's a lot going on. So it's like they laid people off, but some of these places maybe went a little bit too far for their core of LOs that they have, meaning that these LOs can't put a complete file together and put it in and get it through. And right now, Clayton, it's all about contract to close, contract to close, contract to close. How fast can you do it? Okay, that's what it's all about. It's just creating this big muck in the middle.
Yeah, I mean, one of the themes you and I talked about was like the back to the basics. Like, what are the things that great purchase LOs do, market in, market out, and the players, the originators who haven't seen a few markets are going to have a hard time going back to basics because they came in an easier market. And the other topic that I've had come up in like podcast interviews with a few CEOs from big IMBs is like, this is the time that cream rises, and the originators that know how to do those basics and have the fundamentals down will maintain volume in 2022, but in turn grow market share. But the originators without the ability to go back to the basics and do some of the work that's required upon them now that the back office is not as robust are probably going to choose not to stay in the industry too long, or see their volume reduce significantly. And that's kind of seems like that's part of the playbook on reducing margin compression, putting your resources behind the top performers, making sure they live to see the next cycle, but letting the originators or on the other side of the market, the real estate agents who don't do serious volume and don't know how to survive in all cycles, will probably flush out and go back to go to another industry.
Yeah, in the past, there have been what I have called non-strategic layoffs.
Yep.
I'm seeing a lot of the big guys be much more strategic right now. As you know, Clayton, I'm a pretty blessed guy. I work with some very, very big producers across the country, and they are untouched in a lot of these layoffs, meaning their stream of getting something closed is not messed with at all, because they're just taking market share. And their amount of saves, that's another big subject, saves, the phone calls they're getting from agents when a loan officer's blown up a loan, they're just going up daily. They're going up, and which is allowing some of these big dogs, Clayton. I mean, these are market share animals. If you open the door, it's over. They're going through it, and suddenly they're sitting in front of your agent partner that you may have been working with for a while. Suddenly you have one of these big dogs closing 50 loans a month sitting in front of your partner real quick, because you just imploded a loan and you just couldn't get it done. So one of the big things I've been telling people is, man, if you don't have someone around you that can teach you, you need to go find someone, like you all have heard me talking about for years. If you're submitting a loan to underwriting and there's any conditions on that loan when it comes out, with the exception of title and maybe appraisal if it's a pre-approval, earnest money, stuff like that, HOI, insurance, you're doing it wrong. You should have no conditions. If you have if an underwriter ever redoes your income, fail. If there's large deposits and you didn't catch it, that's a fail. You're going to get your business taken from you. Clayton, I hijacked you out of the gate. I know you're always prepared. Is there anything that you wanted to talk about, where you put a link in and the whole bit, any cool articles?
I'll talk. We always try to tie back the headlines to metrics, and I wrote this in our last Lending Life, or one of Lending Life newsletters late last week, and kind of took a look at the MBA's most recent forecast data, which they update monthly, so we get a little pretty nice glimpse, as this data is a couple of days old at this point. They're currently projecting 4.479 million purchase units in 2022, which is an 8% decline from 2021. That number has kind of wavered around staying flat to down, so not a huge shock there. And definitely what's not a shock is they continue with their forecast of refi being down 65%. But when you look into some of those product categories that the lenders started kind of hinting toward finding some revenue diversification in, like non-QM, there's actually a lot of promise there. So in Q1 of 2022, we already securitized 37 non-QM securitizations at $15 billion in securitization volume. In 2021, that was 4.8 billion. So the securitizations in Q1 for non-QM are up threefold over the same period last year, which is really starting to kind of show that non-QM is a product category that's hard to ignore if you're trying to kind of create new opportunities to bolster purchase originations. And I have not seen many IMBs not at least put some guidance in place to when their non-QM products or new jumbo products or new cash out refi products will be fully in market in Q2, Q3, or Q4.
Okay. Interesting. Clayton mentioned Lending Life. It's in the chat right now for those of you on here. Clayton, just tell them what that is. It's a free, just tell everyone, there's newer people on here, so they know they can subscribe to it if they want.
It's a newsletter that we've been doing for about 3 years now, focused exclusively on loan origination, and we try to do a digest of all the content that's covered in HousingWire and a little bit in Real Trends to kind of break down the points that are most important for you to be the smartest originator in your market, with the news and the headlines that matter specifically to you, and usually with a little bit of context in there from myself or one of our editors on something we're seeing or hearing or working on that's not quite in the headlines yet. So free newsletter comes out 4 days a week now, and so hopefully add some value.
So ARMs, super hot topic. What else do you think is just on fire right now? Obviously inventory, but besides that, what else is everyone chatting about?
I mean, like I'm coming off this secondary conference last week, Joel, and like one of the bright spots that came up a lot is lenders' decision over the last 2 years to retain more servicing volume, and as rates have gone up and home price appreciation has shot up, MSR values are looking excellent. So one of the ways that mortgage banks are kind of bolstering their cash positions and preparing to come through this cycle in a stronger way is starting to liquidate some of those MSRs. So we kind of anticipate that there's some impact of that will flow through on the origination side as those MSRs are sold, and hopefully most of them have kind of protection clauses where the buyers aren't calling on those clients immediately. I don't. There's not many mortgage banks that aren't selling MSRs kind of at full clip right now, because as lending boardrooms look toward the next 6, 12, 24 months, there's 3 things that people are really focused on, and one is bolstering up a really strong balance sheet and making sure that there's cash to have optionality if the market gets really tough or if M&A opportunities present themselves. 2 is get margins back in line. Nobody wants to be doing unprofitable lending, and they have to right size the ships or find another way to make sure margins are in line. And 3 is technology. If anybody wants to take advantage of recruiting top originators or acquiring another distributed retail or consumer direct shop, the acquirer needs to have the advantage from a technology stack perspective. There is no way anybody's joining a mortgage bank right now who has subpar technology and taking a step back in their process and origination capabilities. And the same goes for any mortgage bank that wants to do an acquisition. The quickest way to send billions of dollars out the door and acquire a mortgage bank and then see originators just flood the streets is by having subpar technology and making people's lives harder. So the 3 themes that keep popping up are cash on balance sheet, and that's going to come through MSRs, get margins in the right place, and make sure you have the right mortgage tech stack that is hopefully more efficient from a capital and time perspective for originators.
And then, of course, it's interesting, catch-22, because pretty much everyone and their mother is losing money, and everyone knows that to stay ahead in tech, you got to spend money. So, I'm sure those are spirited discussions in the boardroom as far as where they're allotting money. But Clayton, you are 100% right on. I can't tell you how many times I'm having a conversation with an originator and they're thinking about going someplace else or whatever, and we're looking at that. I almost sometimes tell them, hey, have your team look at the tech. Forget about you. Have your team look at the tech. If they're crying, you can't move. You're literally taking a step backwards if you move. And you're gonna, your team's gonna have to work 3 times as hard to get the same amount of loans done. And tech is such a squirrely thing because it's hard to commit, because you commit and then 6 months later there's something newer and you're like, okay, we already committed, to going down the road, and like you can't uncommit because you just be committing and uncommitting your whole career, because there's always going to be something new. So it's really, I think some of these companies with really good chief technology officers are winning, and they're going to continue to win. And I don't mean just some Silicon Valley guy, I mean, or gal. I mean someone that understands mortgage, that like knows what the originators, the front of the house. The back is easier. The front is way harder, as far as to get all the data in. And I think you're right on that 100%.
That's the tech theme that keeps popping up right now, is like the first wave when people started talking about digital mortgage was 100% like point of sale and origination focused. And the last couple of years were spent figuring out e-close and online notary. And now there's like this messy middle of technology where everything else needs to connect for automated asset and income verification and valuation and title and escrow, and making sure there's a coherent line from point of sale to close. And that's the most underinvested part of the mortgage process right now. It's also the most expensive part that's putting pressure on P&Ls. So hopefully that's the place where a big part of emphasis goes over the next few years, which is really felt by the front lines, because the time to close will get faster. The number of headaches that pop up in the underwriting and processing procedures will get lighter, and take some of this weight off of each of you, which from what I understand, it's not been an easy job recently.
Clayton, have you seen any of the larger lenders starting to clean house a little bit with low producing loan officers? Have you seen that going on? Not just the ops layoffs, but have you seen you closed 2 loans in the last 3 months. You've got benefits through here. We're paying for your technology. We're losing money on you. PIP, gotta go. Are you starting to see that yet?
I have not heard that, but I have heard about lower production originators and teams losing support faster. So losing LOAs and processors, or getting shifted to new pods that are just not as good. So that maybe it's like an inadvertent process, or it might be information that I have not heard yet. But I'd be interested to know if that's happening.
I'm hearing that more more than in the past, companies are very quickly realizing that person that was closing 8 loans a month, and 6 of them are refis and 2 were purchases barely, with a 30-year fixed at 3%, and now we're doing 2 loans in 3 months. I think I'm watching companies make decisions quicker with some of those loan officers to say, hey, are you really sure this is for you? Let's go. You can't sit around. You start stacking up benefits, and suddenly you owe a lot. It becomes problematic. But this is a market, where it's been so easy for so long, and now these loan officers are having to work so hard. Maybe they're doing 20 pre-quals, but these are the loan officers that have the pre-quals on that borrower. There's some loan officers sitting around, they have nothing. They literally have nothing going on. They can't figure out what to do, and they're just sitting on their hands waiting for a miracle. We're waiting for maybe the rates to come back down again so they can write some refis. And I don't think they're gonna make it through this. And Clayton, you brought this up. It's important. I've been telling the loan officers, your job right now is you're kind of a consigliere to your agent partners. They're pretty stressed out right now. A lot of these agents that have been riding this train, this easy train of listing a house and selling it in 10 seconds, or having a cash buyer and getting a deal done in 10 seconds, that's over. I mean, the agents are working as hard as I've ever seen them work since I've been doing this. I mean, they are burnt out.
And this might have softened a little bit in the last couple of weeks, but like the big stress point that we've been hearing from agents over the last month is communication from their origination partners, especially when that rates took that rapid ride north a few weeks ago, or I guess last month now, when pre-quals were no longer valid once rates were at 5.5, where they were pre-qualified at 4, or they didn't take Big Joel's advice on the margin.
One over.
Yeah, exactly. Yeah, we've heard. I've been on here enough to know about your one over advice, but it's not a methodology that's used across the whole country. So there is that's been a major pain point for real estate agents, is not knowing if the pre-quals still stand on existing inventory as rates rise, and on new inventory as new construction as home prices have gone up, depending on how they're contracted.
Yeah, I've been basically coaching and teaching from a scripting perspective to, qualify 1 over, tell your agent partners what you're doing. And then if you need to qualify anything below 1 over, it's almost like a red flag loan where the agent knows they literally have to be checking with you daily, because if the rate goes over, boop, your people are no longer qualified. And so it's got to be, and then the loan officer and the agent are working even harder. But, Clayton, this is a whole, people laughed at me and gave me a hard time. And I get all these texts like, Joel, you were right. Oh my God, I can't believe it. I can't believe it. You were right. I thought you were full of it when you were saying, qualify 1 over. The rates will never go up that much, but they could do that, at any time. I just seen it a couple of times already. And a lot of these people haven't seen it. And there's nothing quite like that phone call from your agent partner when you have to tell them they're no longer qualified. And they're like, what do you mean? You didn't cover that?
I spent some time with a group of Keller Williams agents last week, and they were talking about, there's one originator they work with who had been sending them daily videos explaining the rate movement and how it impacts their pre-quals for the borrowers that agent is currently working with. And they loved this man. Like, they loved that they were getting videos explaining how rate movement was impacting their potential buyers. So I thought that was probably it sounds like a little bit like over communication, but the agents loved it.
Well, they're out there busting it, trying to get someone in the house, writing 30 different contracts, then to be told by a lender, oops, sorry, I forgot to let you know that I pre-qualified these people 45 days ago, and I pre-qualified them at 4 7/8, not 5 7/8, or whatever it is, and oops, or forget about whether they're qualified or not. How about just buyer shock? What? That's my payment. I'm out. Very few loan officers have the to right up front show someone a high payment, get them comfortable with it, so they protect their agent partner. I mean, that's a small elite group of loan officers. And by the way, those of you on this call, those are the loan officers that are going to take your business if you fumble. They're the ones. And a fumble is having to tell an agent, oops, your person's not pre-qualified anymore, or their person completely freaks out and ghosts the agent and just leaves because of what the new payment is. And the agent's got 17 hours into showing them properties. Clayton, anything else interesting? I'm looking at the time, and I always like to be very respectful of your time. By the way, in the chat, Clayton put the Lending Life thing, so you could just take that link if you want it. Sorry, Clayton, anything else that you think my group would love to hear? Again, a lot of people are watching on Facebook right now too. So
the last thing I'll share is just kind of be wary of housing data over the next few months. I think we have to all remind ourselves that purchase volumes in last year at this time were kind of all-time highs. And I think there's a lot of weekly reports and monthly reports that are going to come out on application data and new home starts. And I think new housing applications is actually a great example. Like, applications for new homes dropped 14% in April. That's driven by builders having way more unfinished inventory than they've ever had in history, not necessarily builders losing appetite for building new homes. And so I think one thing that I'm trying to do with our newsroom, and I think all housing professionals should take into consideration, that there's going to be a lot of noise in housing data, whether it's purchase apps or new home starts or application data. That's just wonky because of some of these spikes we saw during peak COVID. And so it's just read the articles, not just the headlines. Make sure you're paying attention, because I think it's going to be a lot of noise and data as we kind of muscle through moving to what should be a more normalized housing economy.
Normalized, exactly. That's Clayton. That's great advice for everyone. And I'll leave the rest of you with one more thing. What have you done today to deepen an existing relationship or develop a new one? If the answer is 0, then so far your day is a fail. Okay, what have you done to develop a new relationship or deepen an existing one with a partner that can refer you people that need loans? If you haven't done anything yet today, it's a fail, but there's plenty of time left in the day, even if you're on the East Coast. Clayton Collins, always a pleasure to have you on. You all can still look in the chat. The information is right in there to sign up for Lending Life if you want. It's free. It's pretty cool, and I'm sure that you will like it. And Clayton's advice is awesome, so I would heed it and remember it as you have baby freakouts daily on what's going on in the market. Clayton, again, CEO and founder of HousingWire. And thank you so much for spending time with us. Everyone, we'll see you in 2 weeks. Have a great Memorial Day weekend. See y'all later. Thank you, Clayton.